Okay, welcome everyone. We'll start our lesson 2 on Unit 2, Lesson 2, Corporate Social Responsibility and Governance. So during first lesson, we learn about LO1. LO1 is understand law practice in national and international context, where we discuss about national and international practices. We discuss about legal framework, where we discuss about different legislation, IASB, International Accounting Standard Board. We discuss about International Ethical Standard Board, who set the ethics. We discuss about International Federation of Accountants, what their roles are. We discuss about local accounting bodies, and in terms of the corporate governance, we discuss about what is meant by the corporate governance and all these things, and we discuss about the ethics, what is meant by ethics. We discuss 5 professional code of ethics, those everyone, whoever in practice as a corporate governance point of view, as well as with those are dealing with the financial information, they have to follow those popular people chat in offices, which I discussed with you under LO1. Professional behavior, we discuss about professional competencies and due care. We discuss about confidentiality, we need to keep information clients confidential. We discuss about objectivity. So all these we discuss risk as well, which we discuss different sort of conflict of interest. Those can be compromise your independencies. So all there during our lesson 1, which we discuss these contextive contents, profession, governance laws, practices, purpose. So today we are moving forward and we'll go through LO2. LO2 is understand the natures and the importance of the corporate governance and ethical behavior. So ethical behavior, so there are 3 assessment criteria which we will address: critically analyze the importance of corporate governance and ethical behavior, evaluate ethical issues arising in relation to the corporate governance, critically review solutions identified to overcome the corporate governance and ethical behavior. Then we'll also go through today LO3, learning outcome 3, be able to assess the impact of the financial reporting on a business organization stakeholders. So identify the stakeholders, which will go through different stakeholders. So what impact will be financial reports or the financial statement, those are not appropriate. So LO2 inductive contents, which our discussion will be focused: corporate governance, accountability, fairness, transparency, ethical behavior, agency theory, which we also discuss a bit in the lesson 1, which I'll explain you further. This is carry on because all the people, those are working on the behalf of, they are agent of the shareholders. So we need to be look around agency theory and those prospective to governance. So LO3, which is will go through stakeholders, are the people who can be affected by the action of organization. We'll discuss different stakeholders when we'll prepare the financial statement, how their interests can be influenced. So that's why it's quite crucial the financial statement provide us true and fair information, which can be stakeholder can make the economic decision based on the financial information which provided by the financial statement. Corporate social responsibility, what is meant by how we are really responsible to environment, to people, to profit, and for the sustainability. So these are the practices and theories which we'll discuss today lesson. Please, anybody, any question? Okay. So lesson 2, corporate social responsibility and governance, unit 2. My name is Anjum Sattar and my email addresses are here. In case if you need me, please do not hesitate to drop me email and I'll get back to you as soon as possible. So let's today we'll go through LO2 and LO3. LO1 we already discussed during our lesson 1. Understand the nature and the importance of corporate governance, ethical behavior. be able to assess the impact of financial reporting on a business organization stakeholder. So first of all, what is meant by ethical behavior? Ethical behavior what is ethics? Ethics are the moral principle. Moral principle can be in different society, in different part of the world. It can be things morally different, like child labor in some country. Maybe they think the basic needs not meeting, this child can work, but it's ethical behavior in develop and develop, but in all over the world it's not acceptable. So we need to look around governance, how will govern the organization, how will control it. So all this will go through, like recent scandals about one construction companies it's just recently liquidate Carillions, biggest construction company in the UK, that is going to be liquidated. That's the reason was the poor corporate governance. BHS, British Home Store, is poorly governed. Enron and World Telecom back in 2001, 2002, 99, its scandal start and it's collapsed. So that's why this is happening. So how we can govern the companies effectively, be able to assess the important financial reporting and what impact can be on the stakeholder, how they can be influenced. So all this our discussion will be focused. Some slides I'll just a bit go through in detail, but I'll overview as well. So please guys, when you prepare your assignment, go through these assignment as well, and I'll recommend you some websites at the end. Corporate governance is the system by which the companies are directed and controlled. So keywords: directed and control. So is a system by which the companies are directed. It's covers such as how the power is divided between board and the shareholders, like 3 years ago, Barclay Bank CEO got £2 million worth of bonus. Actually, the Barclay Bank not earned the profit that year. So we need to think about, is it the board is it just decide for the best, just the interest of the CEO, is a chief executive officer of the company or managing director, but we need to protect the shareholder. Actually, those are the owner of the business. If we're not paying the dividend to them, what will they feel? Actually, it's their company. It's not because the director or the managing director or the CEO, they are the steward, they are working on the behalf of. So the agent and the agency relationship is applied here as well. So accountability of the board members, rule and the procedures making the decision, provision of the control, how we can corporate governance provide the structure through with the company objective are match objective of the company. We are here to serve, we are here to satisfy and fulfill the needs of all the stakeholders, attaining those objective and monitoring performance. So all this we'll go through. So corporate governance in the UK. So what's happened when is actually this corporate governance start? So corporate governance during 1980, number of UK companies failed, and some of them resulted as a large scale of fraud by their directors. So these failures reproduce the public confidence in the financial reporting and auditing. Many people believe that the company director regarded accounting standard as a set of rules to be and creative accounting was implicated as several companies liquidation. So creative accounting mean you manipulate the things, so you just creating more accrual, you adding some transaction on the accrual basis. Actually we're not really receiving the cash, so that's come under the accrual basis. So director were always, we need to look around the best, to accept the use of creative accounting. Auditor often receive extra remuneration from the company consultancy work. Disagreement with the director and the audit process could result in the loss of additional income. So the situation often compromise the director independency. So there are number of reasons. There was no clear framework to ensure the director reviews the internal control and in their company. So all these issues leads to provide some solution of these problems. So a need of the system of corporate governance, the committee was established is called Cadbury Committee, and this give their suggestions to improve the internal control and the governance procedures within. So what was the Cadbury Committee? Set up by Financial Reporting Council in London, Stock Exchange Accountancy Profession. Objective was to help raise the standard of the governance and the level of confidence in the financial reporting and auditing by setting out clearly the respective responsibility those involved, what was expected to them. So recent government, conservative government is looking more participation from worker union and various, so all the stakeholders will be part of the corporate governance to be make the things more transparent, more accountability need to be. So that is huge, discussion still going around. So a code of practice was designed to achieve the necessary high standard of corporate behavior. So that was set up in 1992. So recommended, this committee is recommended, Cadbury Committee. It is desirable to separate the role of chief executive and chairman. So their role need to be separate. The board should include the non-executive director. Those are not director, non-executive. For the view carried significant weight. Audit committee should be appointed to review financial statement before their submission full board. Remuneration committee. So remuneration committee will decide. So mainly non-executive for the executive. Those are the executive. Those are directly responsible for the shareholder. The imposition of 3 years maximum term. So after 3 years, these directors carry on chaining, non-executive director. So stock exchange required the listed companies said whether or not they had complied with the code and give the reasons in the area of the non-compliance. So the committee outcome and recommended these things. So then the combined code being set up to combine acceptable principle, the best practices guidance of Cadbury, Greenberry, Hempel into the single code. These are different people gave the reports. Cadbury is one, Greenberry is one, Hempel is one. So these are the 3 different committees, different reports. The stock exchange listing rules required listed company in the UK to include the following annual reporting. Narrative statement, how it has applied in the principle set out the combined code, providing explanation, enable shareholder to evaluate how the principle have been applied. So they should be provide the narrative of the figures those being given in the financial statement, so that fully understandable. A statement as whether or not the complied throughout the accounting period with the combined code provision. If not complied, there must be specified the provision. It's not complied, and the reason of non-compliance should be mentioned. Then is a Turnbull report that was by 1999 Institute of Chartered Accountant England and Wales, ICAEW, to give additional guidance to the listed company how implemented the provision combined code dealing with the internal control and the board responsible. The board should look forward and not just consider the past performance. Company should keep the shareholder informed about the risk. Directors should be aware of the company must be continuous adopt the changing environment. Risk should be reviewed regularly. So risk need to be reviewed regularly because risk carry on changing. The few years back, maybe 2 years before, the Brexit risk wasn't there. When we look around, some risk involved. So risk is mean unexpected outcome. So what is it? Can be positive or negative. So Turnbull guidance in 2003 combined code. So the reports carry on giving, then the codes carry on changing. In 2003, Higgins report to develop the guidance of making a non-executive more effective. So most of the reports remuneration were either written into 2003 combined code or included best practice guidance. There are to it. So then Smith report came as well, 2003, to give the guidance to the company's board in making suitable arrangement for their audit committees to assist the directors serve on the audit committee in the carrying out the role. The report recommendations are appended in 2003 in a combined code of practices. So whatever we are doing in the combined code of practices, all about increasing the so this is corporate governance and their code. The purpose of the code is facilitate effective entrepreneurial prudence management that deliver the long-term success of the organization of the company. So that's the key purpose of the code. So what is the key purpose? Facilitate effective entrepreneurial prudence management can deliver long-term success, so organization success, more independency. Non-executive directors at the time of the Cadbury reports history of the UK public companies dominant by all the power chief executive. That's why the non-executive committee was recommended. So then we look the UK corporate governance. What is key points that has been financial year beginning and after 2010. The code consists main principle, supporting principle, and the provision. These are all about. So these all about now towards we need to look around all these codes divide into the 5 sections. Leadership. So in the companies, we need to find the best leader. Those will lead the company. Effectiveness. How effective our system, procedures, internal control are in place. Accountability. If the things are not performed by the director, what are the accountability procedures are in place within our organization? Remuneration. Do we have a remuneration committee? Relationship with the stakeholders. Are we passing the information to the shareholders effectively? Agency relationship, what we have between, because of course non-exec, all the directors are CEO, those are the steward of for the shareholders. They are working on the behalf of. So the principle of the section outlined together some of supporting principles. So first, leadership. What is meant by leadership? Leaders always influence. Yes, a lot of leadership theory that we learn, maybe, or you heard or you learn something in management. So leader is the person who can influence, who can lead it, who can achieve organization objective effectively. Every company should be headed by the effective board, which is consider of good leadership, which is collectively responsible for long-term success of the company. There should be a clear division responsibility head of the company between running the board and executives. So all this we need to be look around effectively. And then supporting criteria indicate the main principle should be met. The chairman should be responsible, the chief executive. So these is leadership. Then it's come effectiveness. So the board and its committee should have appropriate the balance of skill. So people have different background, different skill. So their views will be heard. So they look around the companies in a different direction, in a more innovative things could be. So that's other key point was effectiveness. So I'm not going through in detail these points, but you can please go through when you write your assignment. Effectiveness is mean meeting the basic criteria that was required. Accountability. The board should present the balanced and understandable assessment of the company position and the prospect. The board is responsible to determine the nature, extent, and the significant risk, which is achieving the strategic objective, long-term objective as an organization. So board should maintain and the risk management internal control. Board should establish the formal and transparent arrangement. Transparency is very, very important. Fraud. To minimize the fraud, we have a checking service. We make sure we only paid what the people are deserve for it. We only say we control, because it's not our money. We are look after the shareholders, because the shareholders are the so that's why is audit committee who at least 3 we need to look around 3 members, and the audit committee would be and normally is carry on rotating. So more accountability, reviewing the company's internal financial control and risk management system. So always we need to look around risk management system. Are we identify not the last minute Korean companies and going to be liquidate? We not why not we took or make the corrective action and we improve our cash flow or the liquid position of the company to make sure the company will carry on. 598 million pound of the pension fund from the Korean company in the UK being misused. So why these are all the issues those directors are internal controller, internal audit committee it can be responsible. Why they not identify remuneration? The level of remuneration should be sufficient to attract, retain and motivate directors of the quality required to run the company successfully. But the company should avoid paying more than is necessary for their purposes. Significant proportions of the executive director remuneration should be structured so as the link the reward, corporate and the individual performance. So that's a lot. Doesn't matter, you can get reward more if your performance is good. So performance related reward system we need to be introduced within our organization. So remuneration committee need to look around what's happened, how much sale, how much is the innovation being bring in the organizations going concern issues. All these we need to be kept in mind when we decide the remuneration, how much reward supposed to be. Relation with the shareholder is the actually owner, so there should be a dialogue with the shareholder based on the mutual understanding of the objective. The board as a whole is responsible ensuring the satisfactory dialogue with the shareholders. And the board AGM is mean annual general meeting. So annual general meeting always company need to call and discuss with the investor what they predict and what our thoughts are. Okay, so guys, this is very important to understand. The concept is called rule based versus principle based approach. So the UK we have principle based approach. Ethics come under the principle. So what are the principles we have? Rules is principles come under the civil law. If you not fulfill the contractual, you have to pay the damages. But if it's a rules come under the laws, legislation. So if you not fulfill the rules, if you can be charged as a criminal. So principle based approach governance as following advantage, because the director report as the actual circumstances of their own company. Reports should be more meaningful than the based on the specific detailed requirement. Code of practices can be changed with the more easily statutory requirement. Code can be updated, like different code of governance we see in Cadbury report, Hemel report, Smith report. So these are all the principle based approaches. Principle based approach encourage the directors follow the spirit of the codes, and rule based is result of the tick boxes, because you have a rule you need to be followed. If you don't follow it, you could be penalized, or you could be fined. So we need to look around these things very closely. Disadvantage: a principle based approach tends to result in general meaning less statement. So we need to be look around these. So some says maybe the rules is more important in some countries, and some countries corporate governance. So thus we need to be look around these very closely in a company. So we'll move to the next. So next we're looking up to there. Okay, so next is Sarbanes-Oxley, which is in America, US laws, and applied all the companies, including in the foreign companies listed in the US stock exchange, introduced the wake up of corporate scandal after the Enron and the World Telecom, and they introduced. So corporate governance can be different in different countries to meet the requirement of the local investor, creating more transparencies, because of course in the developed countries a lot of foreign investment come, so we need to protect the interests of everyone. So more transparency, all these reports is how the companies govern effectively, achieve the strategic objective, all the objectives. Next we're looking now are LO3 LO3 is we're looking first how many types of financial statement. So we prepare in accounts four types of financial statements: statement of financial position, income statement, statement of cash flow, and statement of change in equity. Anybody any question? So please write in the chat box if you have any question. So let's we'll move to next now. So these are financial position shows our assets, liabilities, and capital. Profit and loss shows how much income and expenses we have for certain period of time or during period of time. Cash flow shows how much cash been generating from three major activities: operating activities, financial activities, and investing activities. And the statement of stockholders equity, which is main statement of change in equity. That's which we look how many shares were at the start of the period, how many shares we issue, how much dividend we paid, how much profit we generate, and how much retained earning was before. So all this come under the statement of change in equity. So next we're looking now stakeholder analysis. So stakeholder analysis is the key part of formulating an organization strategy. So stakeholders is mean anybody who has any interest in the business or their interests will be influenced by the action of the company. So we call the stakeholders. Anybody who have any interest in the company is called stakeholders. Even the generation will come after us, they are the stakeholders, because if we pollute now, their interest, their life can be impacted. So those are the stakeholders as well. So important in our organization to understand the needs of the different stakeholders. Strategic manager's job is to be understand the contribution and relationship with the stakeholders, assessing the expectation, and the stakeholders enable organization to gauge whether the objective will provide the means satisfying the demands of the various stakeholders. So key company's objective is satisfying the Now next we're looking internal stakeholders. Internal stakeholders mean the stakeholder those are within the company. Those are known as internal stakeholders. So implies managing director, pay, working condition, and job security. That's the key objective of the stakeholder. So that's why they're looking the profit and loss. If the profit is going up, that's they have a more. If the company have a good cash position, they have. If their asset worth is increasing, the company. So implies managing director status, pay, bonus, and job. So which is based on the performance. If the growth is going occur, the managers want increased profit and leading to increased bonus. So this is all about. Then the connected stakeholder. The stakeholder, those are connected with the company, those have a very close connection with the company. That's a shareholder. Steady flow of income possible. That's why the company want a consistent dividend policy. So every year dividend carry on increasing, consistent. If you pay 1 year, you have a lot of profit, you pay more dividend, and next year you pay less dividend. Of course, stakeholder, the shareholders will be demotivated in that year. So we need a consistent policy. Will even we not earn the profit, still we can pay the income we retain from the previous year profit. If the capital is required for the growth, the shareholders will expect to rise in the dividend stream. Customer satisfaction of customer needs will be achieved through the providing value for money product and services. Any attempt, for example, increase in the quality and the price may lead to the customer dissatisfaction. Supplier paid promptly if the decision is made. Delays the payment, supplier ease of cash flow, and existing supplier may cease supplying goods. Finance providers' ability to repay the finances include the interest, security of the investment, the time, ability of generate cash. We need to be look around. External stakeholders, those are not directly connected, but externally, community at large. Community at large want to be the company will work. They always care about environment. They care about its people. They can generate and provide the well services to the local public. Environmental pressure good. They always keen to be your footprint need to be reduced. That's why now is becoming a compulsory for the company to produce CO corporate social responsibility report end of each with their financial reports. So these the stakeholders can look the information and make the effective decision or put the pressure on the company to take the corrective actions. So government trade union, so their interests and all. So please, then we have a conflict. The conflict, like employees versus manager, is a conflict there. Employees want more salaries, manager want pay less salary, so all this is create a conflict there. Customer versus shareholder. Customer want good quality, cheaper price, but the shareholder want more dividend. So if the company will sell higher prices, the company will earn more profit and the dividend will be more. General public versus the shareholder. General public really want to be look around the effective environment. They not pollute the environment, these companies, and the shareholder, they want more return. So manager versus shareholders, growth versus independence. So manager really want to grow more and work more, but the shareholders really want you. They are work in the best interest of the shareholders. They are independent, but they want to be. So these are the things, the conflicts which we try to be in the corporate governance to minimize them. So next we're looking now. We're looking. We're looking next is ethics. So let's we'll go through now. Ethics and ethical behavior. Ethics are the set out the moral principle and guide the behavior. Ethics values and the exemptions, beliefs, and what they constitute right and wrong behavior. Ethics values are held by the individual and the organizer. So ethics, we need to be look around objective of accounting professionals to be mastering in their skill development of ethical approach towards work and duty of society. They have to be acknowledge they have a duty to serve in the best interest of the public. So always accountant job, or you in accounting profession, you are working in an organization, your job to be work in the best interest of the general public or the public. Okay, so we need to look around. Next we're looking sustainability and CSR. So different theories or approaches we use. Accountant are working in the company, we need to work in the public interest. It's our social responsibility. So we need to understand what is the definition of sustainability. Meet the needs of the present without compromising the ability of the future generation to meet their own needs. So that's UN Brundtland report was produced. That's the report. This is all about. So all the company, they need to be look around the needs of the future generation. Sustainable, an organization should develop its operation to coexist with the society. So society's mood change, like think about the environment. Society want to be cleaner. Of course, so we need to be look around to work towards, reducing the CO2. This can be achieved by putting the long-term future ahead of short-term gain. So we need to carry on investing more money in so we can sustain in the business. Corporate, so it's an obligation. The business feel its local community, person and organization connected to it and society as a whole. Sustainable. So we're looking always in economics, supporting organization profitability, client local businesses, paying suppliers. Social is a supporting labors, community, region, like the food bank scheme of Unilever, hand pump scheme of Procter and Gamble, wash hand scheme in developing countries, and these are all to improve that they have a corporate social responsibility at large. So environmental use, less energy city, create less pollution, supporting policy to manage resources. So these all come under. So today, guys, this all we learn. So just a bit recap. Let's will back to our inductive contents of learning outcome 2 and 3. We'll a bit recap as well again. So we'll go through corporate governance, the company, how control and govern, which we discuss accountability, fairness and transparency, effective leaderships, all we discuss about the corporate governance code of ethics. So always corporate governance itself is more transparent, more fair. Ethical behaviors, the company need to be look around and work in the wider interest of the public. Agency theory, which I mentioned we discuss about shareholder are the owner of the business and the director or the agent, and they have a relationship between them is called agency theory, and they are steward and agent they're working on the behalf of. So further, which we'll go through in the next lesson, we'll contextualize for the discussion as well. So accountability and ethics, we discuss about the not creating a false document, tax avoidance, and the fraud, because like Enron and World Telecom, and I quoted the example of Corellians, pension fund fraud, so which is we not supposed to be. So application of the governance, uh, we look around non-executive committee, remuneration committee, internal control, internal audit, rotation, so all need to be look around. This corporate governance we discuss is a principle-based approach, is not a rule-based approach. Unethical behavior if we're not polluting and not working in the best interest of the public, where moral values it can be ignored. So definition, stakeholders we discuss as well. We discuss stakeholder list of and how their interest and the conflict are, and we discuss about what type of the financial statement we prepare, what type of the financial information these provide, and we discuss about corporate social responsibility theory and practice. We discuss about the Brundtland report. We discuss about the last lesson, Freeman corporate social responsibility theory as well, and Maldinton theory, which I discussed with you during our lesson 1 as well. Today I discuss with you the triple bottom line concept. We need to care about the planet, we need to care about the people, we need to care about the profit. So we all is come our social responsibility as a company to be balanced it, and we work in the best interest of all the stakeholders. So that's all today. So okay guys, so today we learn about LO2, LO3, and we learn about understand the nature and the importance of the corporate governance and ethical behavior, and able to assess the impact of the financial reporting on the stakeholders. So all this we discussed today. Anybody, any question, please do not hesitate to drop me email. My name Anjum Satar and my email address there. Hope so all I will speak to you next week. It will be same time, last, two learning outcome, which we'll go through learning outcome 4 and 5. So please try to attend the lesson and carry on preparing your assignment. If any question, drop me email. I'll get back to you. Have a wonderful time. Have a nice weekend. Have a nice time, and we'll speak to you again. Thanks. Bye-bye.